Kathryn Klose is an experienced consultant and educator, and she's skilled in finance, education, educational technology, adult education, plus management consulting and curriculum development. So a lot of interest in education and skill and experience in that area. And she's currently on the faculty of Montgomery College in the business department teaching accounting. And over the years, she's become more and more interested in cryptocurrencies, blockchain, Bitcoin, all of these interesting new developments in our economic picture. And I'm really glad that she's going to be here to help us understand what it all means. So I'm going to turn it over to you, Dr. Klose. Welcome, and thanks for joining us tonight.
Thank you so much. I really appreciate this opportunity. And I am interested in this. What sparked my interest is I do teach accounting courses at Montgomery College, and we are preparing financial statements that students, and they ask, where does Bitcoin go? And it's like, I better start to address this. In fact, it's amazing some of the changes, not passing physical checks, right, or writing checks. So using digital wallets, these are all part of their everyday lives. If you're students, you probably can confirm this for us. And as an accountant, from my perspective, it's like, how do we account for these? How do we describe them? And how do we present them in our financial statements? So this is kind of a bit of a primer. And then I'll certainly be glad to answer questions. Tonight, we're going to talk about cryptocurrency and blockchain. Blockchain is the technology that makes the exchange of cryptocurrency possible. It also has some tremendous benefits of its own that we'll talk about in tonight's presentation. So tonight we're going to define what cryptocurrency is, explain the blockchain, and we're going to look into the future of cryptocurrency because it changes almost daily. So let's start with a formal definition. So cryptocurrency is any form of currency that only exists digitally, right? So it has no central issuing or regulatory authority. Instead, it uses a decentralized system to record the transactions among individuals and manage the issuance of new units or coins. And it relies on cryptography. So that's where the name crypto comes from. And cryptography is about being able to make things secure in the digital world. So this is to prevent counterfeiting and fraudulent transactions. So that's our formal definition. We're going to expand that a bit. So it was designed to be used over the internet, and it was designed to make it possible to transfer value from a bank or a payment processor, right, instantly, worldwide, with lower fees. Because any of us who are currently participating in the digital economy with things like PayPal or any of the other digital wallets, we know that there sometimes are fees, right? Or if we use EFT, electronic funds transfer, or wire money, we know there are fees related to that. So it's not issued by the government. So it's what we call the sovereign. It's not the fiat of the nation, the standard currency for any of the governments in the world. And certainly the US has not adopted any cryptocurrencies at this point. And it uses this new special blockchain technology to encode and decode information that exchanged. And what we're going to see about this is it provides a terrific record of transactions and how this currency is exchanged, something that paper currency simply cannot do. And there's an equity component of this. Anyone can use it or own it. You can have a piece of it, a small portion of a coin, and get started in cryptocurrency. So it's believed that it could have a tremendous leveling factor in terms of the exchange of money and monetary policy. So when did this get started? Well, in the 1990s, we actually had some of the first forms of cryptocurrency. I don't know. I don't think I was around then, and I don't remember many of them. DigiCash, maybe, BitGold. So these were all the precursors to what we're experiencing. And then in about 2008, a person, they don't know his or her identity, but started to write a paper that detailed the concept of Bitcoin. And the first Bitcoin was released in about 2009 with 50 coins. And it has grown since then to be almost 41% of all digital currency out there. So it's the big currency in the room, and we'll use it as our example as we learn more about the technologies. So here it says it started January 7, 2017. Its price was about $1,000 for a coin. Or by December of that year, it was $19,000. By November of last year, it was close to its peak of $63,000 a coin. Today, we're going to find out it's about $39,000, and we're going to talk about the drop in cryptocurrencies and why they have sort of gone into a slump. But why did individuals want these digital coins? I think is an important question to ask. So some of the reasons really was a lot of individuals don't want any banking system or payment system monitoring what they do. And they wanted to basically reduce fees and eliminate any intermediaries. Now, initially, what that led was to a reaction that cryptocurrencies were kind of for illegal purposes, right? So associated with maybe drug dealers or laundering money, things of that nature. That is changing and evolving. And we're also going to see that if more regulation comes into this market, if the individuals who are participating in those activities are going to find that they're not going to be anonymous anymore. They're not going to be able to disappear into those kind of shadow economies. Other people believe that the currency should be an alternate currency, that all paper money or fiat money should have an alternate currency for accessibility purposes. It can be a hedge against inflation. So if the physical money is being devalued, it can't buy as much. Possibly cryptocurrencies are immune to that. And also in countries where there might be a lot of instability in the country's currencies. So they're hoping that this type of asset would be a hedge against that. So I mentioned that the crypto market is very large. The worldwide global economy, which includes all types of assets, cash, other types of investments, even artworks and things of that nature, is about $93.7 trillion as of 2020. Of that, currently right now, cryptocurrency is 1.9% of that total market. It is interesting that I started this presentation in November of last year, and at that point, the cryptocurrencies were 3% of the market, of the total global market. And that has subsequently been reduced, and we'll talk about why. But it's still certainly on a strong trend when you have something like Bitcoin selling for $39,000 a coin. So this is I believe we give access to the slides. This is a live link, and this is a very helpful website that you might want to go to called LiveCoin, and it tracks all the activity for anywhere from 10 to 13,000 different cryptocurrencies. And the next thing we're going to look at, though, is how big is Bitcoin compared to all of those, right? And here you get kind of a visual map of that. So Bitcoin really is the big coin in the room. And then it's followed by Ethereum, which you may have heard of, Tether, Binance, and Stablecoin. What's also changed since the last time has updated, you might have heard of like Dogecoin and other, they have dropped almost out of the top 10. So it's very interesting. And some of these have features that are starting to make them look more like a traditional currency. So for example, stablecoin is mapped or supported, linked to the US dollar. So it's the only one that can claim to be backed by something. The rest are not backed by anything except for the reputation of the company and the possibility that these coins would have utility in the future, which would give them buying power, right? The potential to buy, or the potential that changes in their price will allow those who invest in them to get returns based on growth, right? To receive realized returns based on growth. So Ethereum has some new blockchain technology in the works. So that has that has always been in second, but it's stronger than it was before. But you can see there is one dominant. And as we look at this wonderful little placement map, you can see how small some of the others are. Anyone can actually create a Bitcoin. And you could name it Kathryn's Bitcoin, right? And you could get it out there. Because of that, some of that, we've had some scams, right? So we've had some people issue coins, collect all the money, and then the coin disappears. So really, tools like this live coin site help you determine maybe the strength of the coin, and then you can research the company and things of that nature if you think you're interested in this market. So are there any questions so far?
How would crypto be more accessible than paper? Is the question in terms of accessibility.
That's a good question. First of all, the way it's issued and it's the way it's exchanged. So it's exchanged through computer networks, right? Which don't have the same regulation as banks, don't necessarily require the same initial setups and things like that. So this is what makes it more accessible. Plus, it's readily available on different platforms that I'm going to talk about, which are called wallet platforms that allow you to purchase it, put it in your wallet, and then either let it hopefully grow, or use it in transactions. I think I read when looking at the history, like the first back in 2009, they bought a pizza for 10,000 Bitcoins. Right. So somebody accepted a Bitcoin for a pizza. Now, it didn't say what the value was back then. So certainly it wasn't a $10,000 pizza, which I'm glad to hear. But it was probably, a $5 pizza, but it took 10,000 Bitcoins. But that was all exchanged through computer. So, and I think, we know even in countries across the world where not everyone may own a computer, we have internet cafes and things that they could go up and, have access to these accounts.
And as long as we're taking a break for questions, I wonder if you can also, Kathryn, talk a little bit more about the benefit. You said at the beginning that Bitcoin has a benefit for equity, which is kind of that accessibility question in a different light. And I'm just wondering if that's still the case with Bitcoin's cost going so high, or is that still an advantage?
Well, I think where that advantage came was that, first of all, most of us could not afford $60,000 for a coin, but you can buy fractions of a coin. And so that's where it became more accessible. Also, if you have a strong enough currency out there, like even Dogecoin, I think is down to 13 cents a coin, right? Mm-hmm. So if you can get one that's relatively stable, has shown a history, you can buy in at a lower price. And, it would cost, you would still be able to have access to this market. I think also, the sheer number of sites out there. But again, I'd caution about doing your homework first, right? So, because we were talking beforehand, cryptocurrency is very volatile, meaning that it responds to changes in the economy and the investment markets, just like a stock would. And in fact, they've shown that they're probably even a little more volatile. So on any single day, it's more likely that a cryptocurrency would lose value than increase in value. On average, they lose value. And I believe Dr. Colleton, we were talking about that earlier. So but if you're monitoring these daily, just like day trading, you can kind of work with that and leverage it. So if you can buy in low and you believe it's going to grow, you may have profits there.
Thanks.
Okay. So now we're going to dig down and we're going to use Bitcoin as the example because it's the big coin in the room. And we're just going to talk a little bit about how this works. So one of the things that is really interesting, and I think is the strength of the cryptocurrency, is the security that the blockchain technology is going to bring. And I think that's what this will highlight. So if we look through, we see that, we have two individuals who want to exchange money, right? So here it says Bob owes Alice money for lunch, right? So he picks up his smartphone. That's the other thing with accessibility, right? He doesn't have to walk into a bank or anything like that. He picks up his smartphone. He opens his Bitcoin account, right? He pays her in this second step. They both have what are called keys, right? And he has a private key that's going to send information to her that he wants to send her money. She has a public key, which will give him access. So he gets Alice's public key by scanning a QR code. And if we know, you remember QR codes are those nice little box with all those little worms inside, right? So yeah, they scan that, at least that's what it looks like to me. And there's access, right? And so there again, you don't have to have a lot of information to do this. You don't have to have this, and this is all digitally exchanged. So the days of writing down tracking numbers or routing numbers and all this great stuff is gone, which we used to do when these first got started. So the payment's sent and it sends a string of random numbers and letters. So this is part of the coding and part of the blockchain that's going to be sent. So anyone who has a public key can send money to a Bitcoin address, but only the signature generated by the private key can release money from the private key. So the public key is open, but the private key is really what's a part of the security that's protecting the exchange. And the Bitcoin app itself, right? The app alerts what we call miners. And we're going to go into some of this vocabulary in more detail. So miners around the world, these are people sitting at their computers, anticipating these transactions and getting ready to jump in and do a lot of coding and algorithm generation and things like that to try to access the blockchain and what we call verify the transaction. And when the miners verify that Bob has enough Bitcoin to make the payment, right? And then they race to bundle this data with other unrecorded transactions, plus the last block in the blockchain, which we'll dig deeper into, which is like a public ledger of the transaction. So it's saying, Bob is paying Alice, this is what he's paying, et cetera, et cetera. It happened on this date. So it verifies the transaction. Then the miner, I said they're applying mathematical functions known as hashes to produce a unique fingerprint that verifies the transaction, and then will signal to others that in this crypto environment, that this is a good transaction. So the hashed block is what it's called, and it has to have a certain but arbitrary number of zeros at the beginning. So part of this mining is looking for these algorithms and these automatically generated numbers. And when they can prove that it has the correct amount of zeros, they can verify the transaction, add their signature to the blockchain or their information to the blockchain, and pass it on through the system. And when the miner finds a hash with the correct number of zeros, the discovery is announced to the rest of the network, right? So this miner, Bob, or excuse me, I shouldn't say Bob because Bob's sending money. This miner, John, has verified the transaction. So they communicate this to each other. And then the algorithm, for cracking this algorithm, it rewards the winning miner with 25 newly created Bitcoins. So the hashed block is published in the public ledger, and the miner gets rewarded. I called it, this is how, for me, if I make an analogy to existing currency, this is how Bitcoins or crypto coins are minted, right? So they're not minted out of a central authority. They're minted out of people exchanging the coin, miners verifying the data, and then they get rewarded. Now, the question that we all look at is, do the miners sit on their coins and wait them to grow? That's probably how the early miners made money off of Bitcoin. Yes, right? They sat on it. They saw that price going from 19,000 to 60,000. They sold off in there and they made a tremendous amount of money on the cryptocurrency. That's going to be, there'll be fewer and fewer opportunities for that because there is a limit on how many Bitcoins will be released. And we expect to reach that limit probably within the next 5 years. So then the discussion will become, what does Bitcoin do after that, right? But that's essentially how this exchange, and this is all done within 10 minutes. So you may hear about mining operations, like in North Carolina, there's a huge one where it's just, in fact, they're set up in railway cars, and it's just thousands and thousands of computers running these programs to try to validate these algorithms and mine Bitcoin for the miners to be rewarded. It is an extremely energy intense activity, and this is one of the criticisms of it. I don't know if anybody's done a comparison between the federal mint and the cryptocurrencies, but I think they'd probably intuitively tell you it could even cost more than physically printing money because the amount of electricity and the impact on the environment. So that's kind of how we pass through this. So we're going to take one more deeper dive into that, just reinforce some of the vocabulary, right? So first of all, Bitcoin, the Bitcoin app is what we call the wallet, right? Some people look at it, PayPal or as a wallet. Venmo, PayPal, they're types of wallets, but they have, there's more monitoring going on in those. There's more arrangements going on in those than you would have. The other two, one of the biggest wallets is Coinbase, and then we have Bitmap and eToro. So they're a lot of my students use Robinhood, and that one a while back was associated with a problem that they had with the GameStop, run on GameStop. So then we talked about private and public keys. Right here, it tells you what it is. I'm not going to read all of these, but basically it's a huge number, right? It's a huge number, and it has cryptography in it, and it unlocks the virtual vault or the virtual wallet so we can exchange the currency. And again, the public key is similar in nature, so it facilitates, it's not locked, but you have to have kind of the information from the private key to knock on the door and open the wallet. And then the QR code, we said that exchanges, it's machine readable optical labels, right, that contain information. And then there's a digital signature. So this is all the kind of information that's added to the ledger or the record that we call the blockchain. I talked about mining, right, performed by individuals on these distributed networks. So this is a lot of peer-to-peer computing. It's not centralized. That's another beauty of it. So if you think about tracing money through a system, how many thousands of computers that this may pass through, right, or be involved with, as opposed, and how difficult it might be to find, right? Except that when they finally verify the transaction, the record is printed on the transaction. So I'm going to talk a little bit later about, in the end, it would be very hard to go undetected in a totally crypto economy. So there's certainly software. The public ledger that I talked about is called the blockchain. That's the bundle of data that tells about every transaction that's made. And we talked about the hash. The hash is what they're trying to confirm, that really says, yes, this is a good transaction and we can verify this transaction. So, and the last was the rewards, because no one's issuing it. So it's done through this reward system, rewarding those who are involved in this economy and making this economy happen. So I mentioned the popular wallets. So Coinbase, I think Robinhood, they're the ones you'll hear in the hallways at Montgomery College, as our many students get into it. This again too talks about the mining, and I'm not going to go over all these in detail because I'd like to leave room for questions and just discussion of your experiences. But here again, it talks about having to see, right, how these, where the information fits on the block and how the miner can verify it by examining the transaction and hitting on that secret algorithm. So a lot of people think that what the best thing to come out of cryptocurrencies is this blockchain technology. So the blockchain technology is really what makes the digital exchange more secure than ever before. And I said in the 90s, we were experimenting with these types of currencies, and they had problems with security and verification, and the blockchains is going to help with that. So when a transaction is requested, the transaction is broadcast to this peer-to-peer network that consists of many computers, or nodes, as they're called, and they use known algorithms to validate the transactions and the user status, and then they verify the transactions. And the transactions too, and you've probably heard of this, we were talking about this before, can involve cryptocurrency, contracts, records, what we call non-fungible tokens, which often relate to artwork or digital expression, right? So a blockchain can be used for any of this, and this is the value. It's not cryptocurrency specific or only restricted to cryptocurrency. So the transaction is combined with other transactions, right? So that's where we extend the block. So here's the initial information. I'm the miner. I'm going to put on verify that information and add a little bit more information. And as the currency is passed and passed, the block gets longer, and we have a complete record of where all this currency has been. And that's what's the exciting part, because it can be used for other things besides crypto. We will see that there is, and I'm going to go ahead here. We're going to see it in the fields of healthcare, identity management, provenance. Provenance means the origins of something, right? Usually it's used in the art world, and smart contracts, supply chain management. So what has come out of this economy in the past 20 years now are some of these top blockchain companies that actually work in these areas, right? So we have a list here, and notice maybe we recognize IBM, right? And Coinbase, but a lot of these are new ventures, right? That were developed to handle this new technology. I want to mention this because I also think this is interesting regarding the security. So it's like you can't have bad actors in this economy as easily, because since we have so many miners out there, it requires kind of distributed and multiple consensus that a transaction is good, right? So that is why they say it's more resistant to fraud, right, and fraudulent activity. And that's why, too, it makes it secure for these other types of transactions also. So I'll stop here on the kind of techie part. Are there any questions related to that? I didn't.
And I'm collecting some questions that I think we'll hold off till the end. And
Okay.
if you're answering them as we go.
All righty. So let's talk about the future of crypto, because I think, once you won't get the technology in one day, but if you review the slides and you read more about it, you'll start to recognize the terms and you'll start to understand the technology, right? So, but what are we going to do with it, right? What are we going to do with the currency? What's going to happen with blockchain? So one of the strengths of it is because it's traded on markets, you can trade Bitcoin, right? And you can buy it and you can trade it back into dollars, right? So there is this ability to exchange it. So you can also trade it for other cryptocurrencies, right? And anytime you're trading back into a dollar, then you can take your dollars to purchase a different currency. So there's also one of the reasons why it's liked by its users is there's no distinction between users and merchants. So everybody's a participant, everybody's security has to be validated, everybody's transaction grows a record, right? So we can see not only users, but we can confirm what merchants are doing in exchange, right? So in that regard, these features here make it sound like it's any other currency. And while the value of cryptocurrency like Bitcoin is zero, right? Right now, it's really zero. It's an asset that's zero, right? And Warren Buffett, I just watched a clip and he was asked, and we know that he has made a lot of money in his lifetime, and he's a very active businessman well into his 80s. And he said, the issue is it's an asset like cash, but it's an asset that has no utility. So until it can do something, right, he has no confidence in it. So the confidence in the cryptocurrency depends on the expectations of each investor as to whether or not it can become an alternative currency. So right now in this period, even the IRS considers it like any other investment in a stock or a bond or something of that nature. So it's not considered cash. So when my students ask, or dear students, when you ask, where does Bitcoin go on the balance sheet? It goes under investments, right? It does not go under cash. It's not considered cash. So we have to decide what's going to happen. So right now, as I said, why people have made money on it and why they seem to have a perceived view that it has value is because people who got in early for $1,000 a coin were able to sell at $19,000 a coin or even $60,000 a coin. But that era, I think, has passed us because the threshold, one, we see Bitcoin, there's only about 5 that dominate the market, and they're mature in terms of their price, right? So you're not getting in on the ground floor. You're not getting a ground floor deal. And so then you have to say, well, what else is it good for, right? So first, I'd say, though, if you're still interested, and there do appear to still be some opportunities. So if you are looking, just like traditional investment, if you're looking for an income stream, there isn't any cryptocurrency that pays dividends or interest, right? So some pay on the mining of the coin, and you get a coin through mining, but you're not going to have a revenue stream like a stock or a bond. If you are counting on the growth, meaning the increase in price, right? Then if you look at, and probably Motley Fool is one of my favorites, right? But we have Jim Cramer of Mad Money. You see him on TV all the time. He said your portfolio should be 5%, right? And it could be Bitcoin, or diversify, have a couple different coins, right? Motley Fool, it says, look to gold, right? And to be honest, I just sold some gold jewelry that I've had for years and I'm not wearing anymore. And I was really pleasantly surprised. So, some people say it's better to go, that's something tangible and it's retained its currency over hundreds of thousands of years, right? And then CNBC says 59% in stocks, 1% in Bitcoin, and 40% in bonds, right? So the message there is diversify if you're looking to get into this. And then you also you know your risk level, right? So that's something that also determines how we create a portfolio of investment. So, maximum in your portfolio of crypto, right? You're going to have 5% would be an advanced. So advanced 2 would mean that you have a lot of experience in investment markets, right? And you're comfortable knowing that you have exposure and that you could lose value, right? And lose return on your investment. What's also interesting, I think I read somewhere here, I don't think I have it in this slide, but the typical cryptocurrency investor is a 35-year-old male in a white collar job making over 6 figures. So I think we have this feeling that there is accessibility and that all of us are in it, but the ones who are really active in it are in a fairly stable and higher socioeconomic bracket. So right now, crypto is 100% speculation, right? And it remains unpredictable and it remains difficult to forecast. And even if we look at some of the reasons why the value has changed, it's basically has to do with the currency has shown to be volatile. It's not necessarily, it has the volatility of any risky investment on the market. So it will go in a similar pattern. We said it can be, it's usually down in any given day. Today, right before I checked, all of the top 5 were down. That can change within an hour, which is interesting. The other thing is, and it doesn't prove to be the hedge of inflation that we thought, right? Because no one's accepting it. So it's not like you can go out and buy more with your cryptocurrency, because right now, unfortunately, no one's accepting it. And there was a ray of hope, and I think it's kind of tragic, the circumstances, but there was talk when the Ukrainian conflict started that the Ukrainians would be able to buy what they needed to fight their war with cryptocurrency, but that has not materialized, right? And even there was also this, the Russians would use cryptocurrency to skirt around the restrictions that have been put on their economy, and that hasn't happened. So it's not mature enough for exchange, except, and then the last thing is President Biden said, well, you know what? Just like some of the other countries who have adopted or introduced the concept of cryptocurrency, and that would include Dubai, Venezuela, Estonia, Russia, Sweden, Japan, right? And even we have El Salvador, which made the news the end of last. So they all have their own. President Biden said, maybe we'll have our own cryptocurrency as an alternative currency. When we do that, then all those kind of benefits, like not being detected and not being able to participate in a shadow economy or keep your transactions under wraps, that will all go away because the government will then have issued the currency. It'll become fiat currency, and the government will have access to all those blockchains with all that information, right? So the benefit of having this kind of decentralized, lowly monitored, minimal monitored currency will go away. So So some people say that compounding interest is a better bet. So put your money not in the mattress, but in the bank and let the interest compound. And certainly that you should diversify, right? And you should diversify among the coin. If you're going to have 1% crypto in your portfolio, diversify among the different currencies. So I'm older than many of my students. I still follow traditional investment policy. So if I'm going to be moving now from stocks and growth to income, Bitcoin's not going to be in my portfolio, right? So even if I have 10 or 20 years of work, it's probably not a fit for me. If you're interested in learning the dynamics of investment and have some money that you would not be concerned to lose, right? Then certainly it's a wonderful way to experience the investment market and learn something.
One of the questions I thought was really interesting came from one of our faculty members, and the question is about whether the value of crypto does it fluctuate like with the psychology of the investors, or I mean, what determines whether the value goes up or down in crypto?
Well, I think that to some regard is not completely determined yet, because the initial thinking was, as we've examined its behavior, is that it responds like stocks in the stock market respond. Mm-hmm. But now we're seeing that it doesn't have as close of a connection, and there's a finance term for that, but it doesn't move in the same proportion as necessarily. I think world events, this is my opinion that I'm giving, world events probably have the greatest impact on it now, because it's whether or not it's going to have utility, right? So you saw it go down because of the announcements of the US government possibly adopting it. You saw it go up with the Ukrainian conflict. Right. It hasn't taken the traction that they had hoped in some of the other countries. So until it really can become a widespread alternative medium of exchange, you're going to see that volatility. So I often say that today it's not about information in the markets, and Bitcoin is in the investment markets. We have what I consider emotional markets, right? That emotion, because first of all, computers have made information exchange instantaneous. So the kind of edges that people would get, or the advantages people would get by having some information early, are almost eliminated. So now it's almost this emotional reaction, like we hear it every day. How did the market perceive, right? How is the market going to perceive this latest Supreme Court issue, right? So we have a lot of emotion in the market. I think we always think it's very quantitative, but there is a lot of qualitative.
That's so interesting. Wow, thank you. And do you think, I mean, this is speculation on something that's speculative, but do you think that there is a place for crypto in the market for where people will actually be able to use it to purchase things, or is that anathema to its character?
No, where I would hope that it could be developed, right, with great utility, is in underdeveloped countries, or countries that have issues with stability in their currency, in remote locations, so that we could make we could make financial support, or we can make we can make money itself more available to people who need it, right? So, if we have our charitable organizations that want to do work in certain developing areas, and it's been difficult for them to get funds there, but if that country can set up crypto and have it actively exchanged, I think it does have power there. It has power from the perspective of equity and inclusion.
Yeah. So on an international level, that's one of the benefits of it being internationally recognized or
Mhm.
usable. That's really interesting. And you might have talked about this while I was taking notes on people's questions, but if not, I think it would be helpful for us to understand. Are there privacy issues? I know that there's so much information that's collected in the blockchain. Is that something that people worry about or that we should worry about?
I would, so first of all, we're told that it's the most secure system because of that consensus issue where a lot of miners have to agree. And
Mhm.
so this is called proof of work, right? So on the blockchain, when a miner adds information and verifies information, they extend the blockchain with something equivalent to like a coupon, right? That says, I've been here, I checked this out. There is no advantage in the system for a bad actor to validate a bad transaction, right? So when I presented it, I said, well, you have to have consensus. You have to have a couple miners. They'll look at it and they'll say, well, I won't mind that one because she got it. She got it right. She validated it. It's hers. So they say that's where the security is. I think all of us, though, have to be sensitive to the issues of cyber hacking, right? So when we start to be able to crack into these peer-to-peer networks, although these are, the highest end computers. I mean, it takes a lot of cash to be a miner to go in. There's a kind of high hurdle to be a miner, or they know the locations of these mining camps that are getting so much publicity. I would have to say that they are subject to cyber attack, and we know cyber attacks are more organized than ever before, right? So I think they'll always be re-examining the security, even though we see some downsides, right? We are living in a potential change in our history of finance, right? So I think if you are of a curious mind and you can tolerate some risk, this is a great period to learn about what might be the new economy for future generations of ourselves. So.
Thank you. Thank you. This has been so fascinating. And I just want to tell you, we've got as big a group here with us tonight, which really reflects, I think, the interest in this. So there is a lot of curiosity, right? We really are wanting to understand this. It feels like a new frontier.
New frontier, yes.
Yeah.
Well, thank you for your time. I truly appreciate it.